Hello and welcome. In this class, we are going to discuss about sectoral rotations. So the idea about sectoral rotation is we want to reduce risk while investing in equity. Now the main premise of it is all sectors don't react to economic cycles in same way. So there are two economic cycles, expansion and recession. So all sectors that are there in the market, they don't react to these economic cycles in the same way. There are some sectors that react more aggressively. So these are called as aggressive sectors. There are some sectors that don't react much. So these are called as defensive sectors. So like we have discussed, there are two economic cycles, expansion and then recession. So there are some sectors that perform really well when expansion happens because their sales are directly related to the economic activity going on in the economy. So if economy is doing well, their sales are good, so their profits are good and their stock prices are doing well. If economy is not doing well, if economy is into recession, their sales fall a lot and their stock prices also tend to do that. Okay. Defensive sectors are sectors that are not much related to the economic activity. So they are counter-cyclical or cyclical. So examples of aggressive sectors lead the market. So when expansion happens, their stock prices react a lot, so they increase a lot, and their stock prices fall a lot also in recession. So examples of examples of aggressive sector can be automobile, information technology and tech industry, banking, defense, construction, infra, and luxury goods. Defensive sectors are sectors that don't react much to the economy. Examples of that can be utilities, all the necessities that we have, low cost consumer goods, as well as pharma and healthcare sector. Example, as a person, you don't stop consuming pharma medicine, let's say like aspirin, when recession strikes, right? So sales of aspirin is not extremely highly correlated with economic activity, but you will stop buying Ferraris if you don't have a job. So that's a major difference. So since their sales is not impacted much by the economic activity, these are called as defensive sectors. Now we can classify these according to their betas. So aggressive sectors, beta is reaction of stock to the market movement. So if the stock has high beta, it will react higher than the market. So if market goes up, the stock will go higher than the market. If market falls down, it will fall down further than the market. Okay, low beta stocks generally drag behind the market. So if market is rising, the stock rises slowly than market. Market is falling, stock falls slowly than the market. So beta is an indicator of how stocks move with the market. Generally market is considered to be an index. So beta measures sensitivity of the stock to the movement in index. So aggressive sectors generally show high beta, defensive sectors generally show low beta. So what you can do as an individual, you can combine high beta stocks with low beta stocks to reduce the risk of your portfolio. So just to recap, there are two types of sectors: high beta sectors that are aggressive, low beta sectors that are defensive. The summary of the discussion was you can combine high beta and low beta stocks in your portfolio to reduce the risk of the portfolio.